Good evening, friends. We are aware that Indian IT sector has witnessed significant correction in the recent past on the back of multiple factors like volatile external environment, slow earnings growth. But does this noise really pave way for an opportunity? To understand this more holistically today, we have with us our fund manager, Mr. Balakumar B. Bala has had a significant amount of experience in equity research over 9 years, and he has completed his BTech, MBA, and CFA. And over here, he manages our HDFC Technology Fund. We thank you for coming over onto this call, and Bala, also we welcome you onto this call. Participants, please note that we will be taking up the first Bala will be presenting, and we will be taking up the questions at the end of this at the end of his presentation. Thank you so much, and over to you, Bala, to explain.
Hi. Thanks, Aditya. Thanks for setting the context. Hello, everyone, and welcome you all to the presentation. Thanks for taking your time out on a busy evening. As Aditya beautifully said the context, we are here to discuss HDFC Technology Fund. In India, technology is predominantly IT services as of today. And if I look at the growth, especially over the last 2.5 years, there's been a meaningful slowdown in growth, which is also reflected in the stock prices. The stock returns have been muted relative to the market and also on an absolute basis. From our perspective, when we try to think through what are the key questions which are on top of investors' mind when one is considering investing in the sector, we came up with a few questions or debates. Some of them are artificial intelligence, the new buzzword. What does it mean, whether it's a headwind or a tailwind to growth? And two, uh, the recent executive order on additional charges for new H-1B visa applications. How does it impact the operating model of Indian IT services players? Three, like I said, there's been a slowdown over the past 2.5 years, whether the slowdown is structural or cyclical. In addition to IT services, our fund can also invest in telecom and internet space. Though there's been a meaningful increase in the number of uh, smartphones or online shoppers, etc., we also wanted to understand whether there is still room for further penetration in the Indian internet space. So we will address these questions in detail now. First, moving to artificial intelligence. Um, so just taking a step back, 30 years ago, this industry was a sub-billion-dollar industry, and today, just in exports, we are over $200 billion. And so we have gained meaningful scale over the past 30-35 years. And in every year, if we plot the year-on-year growth chart, every year Indian IT growth has been ahead of the global IT services spending. So over the past three and a half decades, the sector has grown ahead of the industry and also taken market share and has become a scale player now. And if I look at the past 30-35 years, there have been meaningful technology changes, be it enterprise applications in the early 90s and then the 2000s, or be it cloud post GFC till since 2015 and 2020. There's been meaningful technology changes, and all these technologies had the same proposition. There will be meaningful productivity or cost savings. So initially, there was a question on everyone's mind whether these technologies will lead to lower services spend, which is the bread and butter for Indian IT industry. So in what we have seen in the past is during the initial phase, till the adoption picks up, there is a slowdown. And once the enterprise-wide adoption, be it what we have seen in cloud or be it in ERP, whenever that enterprise adoption happens, the services spend actually increase. So today we are in the very nascent years of AI, and there's been a crowding out by hardware spends, which is compared to the services and software spends. So in our view, as the enterprise adoption of AI picks up to meaningfully to to monetize the capex which they have already put in place, then the necessity for applications would increase, which means the services spends will increase, and we will see this becoming a tailwind for Indian IT over a course of the next few years. So in short, with every technology, the initial years have raised the question whether services spends are relevant. But what we have seen in the past is that after a few years, when the enterprise-wide adoption picks up, then you see a meaningful pickup in services spend. We believe that this could play out in AI as well. The second key question, the recent executive order on H1Bs, that there will be additional $100,000 fees for each and every new visa H1B visa application. So before getting into the H1B visa part, probably I would like to look at the bigger picture. It all boils down to the availability of talent. If you look at the left side chart, in terms of the stock, the number of people in the tech world, India is the second largest, next only to the USA. But more importantly, the middle chart, if you look at it, which is the flow, where do you have um, the flow or the annual, the yearly graduates in STEM? STEM refers to science, technology, and engineering and mathematics. If someone is qualified in these disciplines, then he or she is uh, likely to be eligible to work in this industry. So if I look at the flow of talent, then clearly India stands far ahead, 3x of US and much more when compared to the other economies in terms of the annual uh, flow of STEM graduates. So clearly India is a dominant force in if the tech if the tech industry continues to grow, then possibly it is dependent on the Indian talent ecosystem. And this is what was also reflected in, if you look at the news flows around the increasing number of GCCs, which is the captive centers of global companies setting up in India, or people moving from India to other countries on visas to work there. I think both these also signify the demand supply gap in terms of talent and the advantage which India has in terms of the annual flow of tech talent. So clearly, we hold an advantage here. And coming to the specific issue of H1B, if I look at if I compare today's scenario, 2025 versus 2016, then the operating model has significantly reduced the reliance. Indian IT services operating model has significantly reduced its reliance on visas. For example, in 2016-17, uh, 2 out of 3 people working for with an Indian IT services providers were on visas, and today is just 1/3. So the ratio has reversed. And if I look at the on-site mix, the number of people working at on-site locations, that has also come down since the pandemic. So post the pandemic, the offshore percentage in terms of total employees have increased, and within the on-site proportion, the mix of visa holders have also come down. So clearly, from an operational standpoint, Indian IT is much better placed when compared to 2016 to 17. And if I look at this specific order is applicable only for the new visa applications. It doesn't impact the stock. So clearly the impact would be much limited in our view. And there are mitigants through which the industry can also probably get away with the meaningful, can reduce the impact on the current order. One is they can, like I said, today 2/3 of the people, 2 out of 3 people in the US are locals. Uh, the companies can continue to increase that number, that proportion. And second thing is they can it can lead to increase in offshoring or nearshoring locations. And third, if a customer needs someone to be sent on visas, then possibly there could be agreement arrangements to share the visa fee or between the customer as well as the employee. So clearly there are first point is uh, since it's only on new visas, the impact is likely to be minimal, and there are mitigants to also reduce the impact. On the third one, which is the slowdown, whether it's a structural or cyclical one, possibly, like I said, again, last 2 years there's been a slowdown. But I think if you zoom out and probably look at the last 15 years of growth for the industry, we have had different cycles. For example, from FY11 to 16, it was a pretty strong growth cycle, growing at low 13% CAGR, whereas FY16 to 20, the growth slowed down to 8%. Whereas post the pandemic, there was a high because it was the online was supposed to be the only means of communications post during the pandemic. The spends on technology and being relevant on technology was quintessential for the companies. So there was a spurt in terms of technology spends for all the companies, which led to a 14% CAGR in growth for the companies during FY 21 to 23. 23 to 25, last 2 years, there's been a normalization of spends. And this is also a period when US Fed was also increasing the interest rate. So, and there were concerns on a potential global economic slowdown because of high inflation and currently due to tariffs. So, if I look at a 5 year period, then again, it was like a short 2 year of strong growth cycle, followed by now at 2.5 years of a muted growth. And like I said, this is primarily due to two reasons: one, normalization of spends, and two, there were increased concerns on a global slowdown, both due to high inflation and now due to tariffs. So, in our view, as and when the macroeconomic worries ease and then the situation normalizes, then the growth should improve to normalized levels. And fourth, on the digital penetration, I think, like I said, if we compare the scenario today with 10 years ago, we could clearly see that the smartphone penetration as well as the internet penetration has increased in India. But if we compare our situation today with some of the developed markets like US or neighbor China, then possibly if I look at e-commerce as a proxy, then our e-commerce penetration is still in single digits, whereas for the US it's about 20%. So clearly the potential for growth, the room for penetration is still high despite what we have achieved in the past 10-15 years. Again, the same story. I'll just focus on the top left chart. If we look at the Indian e-commerce market, it's expected to more than triple from 2023 to 2030. So that also signifies the growth potential which we have. So finally, having addressed the four key questions, um, just moving on to the valuations part. Like I said, if you look at the left side chart, if you look at the uh, PE bands of the BSE Tech Index, our benchmark, during 2021, because of the high growth phase, the PE was also at a peak. But in the last 1.5 years, there's been a PE normalization, and currently the PE is trading below its 5 year as well as long term average. And more importantly, if you look at the middle chart, which compares the premium or discount of the index to the broader benchmark like a BSE 500, so currently the sector is trading at much below the long-term average premium which enjoyed. So it's still trading at a very modest premium, but this is a sector which always enjoyed a healthy premium of 20 to 30% compared to the broader benchmark, because this sector had reasonable growth, had good ROCs, return capital, return metrics, low leverage, and very superior dividend yield. Because of these metrics, the sector always used to trade at a premium to the benchmark. But today it has the premium has meaningfully come down and it's well below its 5 year and 10 year averages. So if you have to combine the left and the middle chart, you could clearly see the sector valuation is now close to its longer term average, and relative to the benchmark, the premium has clearly come below its long term averages. And during this period, the dividend yield has actually moved up for the whole sector. So we have superior dividend yield, which are much below the historical premiums to the broader benchmark. So if I have to summarize why probably one should look at investing in the space, I think I would give few reasons. We discussed the key debates today, but if I have to give a medium term view why one should consider investing in that space, then probably the first reason would be uh, the tech intensity. Has been increasing across sectors as well as across industries over the past 2 decades, and this is not something which is going to change. And two, in Indian IT, you have a very well established scale model, and they have been a consistent market share gainers over the past 3.5 decades. And like I mentioned, talent is India's biggest moat in the world. If advancements in tech has to have will happen, then probably there will be a big involvement of the Indian talent ecosystem in those advancements. And three, if I look at the domestic digitalization story, despite the penetration we have seen in the past 10-15 years, there is still a long runway for potential growth. And finally, from an entry point perspective, I think this is a uh, sector with good historical growth and return metrics, with a superior dividend yield currently available at reasonable valuation. So we think this is one space which one should consider investing at this point in time. I'll briefly introduce our HDFC Technology Fund. It's a 2-year-old fund. We were launched in September 2023, and the fund mandate is that at least 80% of the AUM will be invested in technology and technology-related companies, which includes IT services, software, products, and like I said, internet, telecom, and media as well. And this is our current major holdings as of today. And the like I said, if you look at the growth, there's been a growth slowdown since FI 23 from FI 24 and if I look at the returns, the sector has underperformed the broader benchmark since FI 23, 23, 24, and then 25 was largely in line, and FI 26 by TD also there has been a meaningful underperformance. But if you look at a longer period, then this sector has outperformed the broader benchmark in majority of the periods. So currently we are seeing a very uh, we have seen very low returns, which have increased the attractiveness of the sector relative to the market. So that's why we think probably this is a one time to consider investing in the space. And this is our performance related to the benchmark over the past 1 year and since inception, which is 2-year period. So on the risk part, I think so one is this sector is highly related to the macroeconomic growth, which also led to a slowdown in the past 2 years. But I think, like I said, the value proposition of tech is also evolving, which means that uh, the tech spends are much more sticky, and as things normalize, then possibly growth comes back. The other one is this is a highly people-driven industry. So whenever there is a high employee turnover, then it also impacts the profitability of the customer. But the mitigant here is the talent supply. Like I said, India has about 22 lakh STEM graduates annually, which also puts it in balance, which also makes gets the demand supply back to equilibrium at a faster rate. And in terms of the competitive intensity, here the companies enjoy very long customer relationships. There is an incumbency bias. The renewal rates are pretty high in the 90% rate. So uh, the companies enjoy very strong modes in terms of renewals and then customer relationship. And government regulations, like I said, visa. So today the operating model is much better placed when compared to what it was 8 or 9 years ago. And whenever uh, there is an adverse impact on global mobility, it also leads to higher offshoring, which benefits the industry in the longer run. Uh, this is my profile. I think, like Aditya mentioned, I have 14 years of experience about running the fund for a little over 2 years now.
In-depth and detailed explanation on such a pertinent sector and topic at this point of time. And I thank viewers also to come take your valuable time out and attend this call. Thank you so much, and we can end this call.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.